Today we'll talk about how whole life insurance works and how you can get the most cash value. We'll start by talking about how it works. So with a whole life insurance policy, we'll see three main pieces. First, we have our death benefit. Then we have our premium and PUA rider. We'll explain both. And then we have the cash value, which is what everyone is interested in. Let's start with the death benefit. This is your actual life insurance benefit with a policy. How it works is when you die, if you are the insured of your policy, that death benefit is paid out. Now, death benefits are always paid out 100% income tax-free. While they are income tax-free, they are not exempt from estate taxes. So if you have a very high net worth and it's subject to estate taxes at your death, the life insurance death benefit would be included in that. What some families and individuals do is elect to have a large life insurance policy owned in what is called an irrevocable life insurance trust, which is outside of their estate to help leave more money to the next generation. With the death benefit, we label what is called a beneficiary. Now, I can have one beneficiary or multiple beneficiaries. It can be one individual or several individuals. It can be a business or it can be a trust. When I die, whoever my named beneficiary is receives those dollars, the actual death benefit proceeds. With a whole life insurance policy, you'll typically see the death benefit gradually increase over time. And again, when I die, it is paid out 100% income tax-free. Next, we have our premium. Let's start with this guy. So the premium with a life insurance policy is set at the beginning of the contract. So if you're told your premium is $2,000 per year, you are contractually locked into that premium. It will not increase as time passes. So it's set at the beginning and it is due for the contract term. That contract term could be forever. So if you have a life insurance policy called a Whole Life 100, that means premiums are due until you're 100 years old. If you have a policy called a 10-pay, that means premiums are due for 10 years. So again, the premium, the actual dollar amount, is set at the start of the contract, and it is due for the entirety of the contract term. 100 would mean until you're 100, and a 10-pay would be 10 years. The premium can be paid annually, semi-annually, quarterly, or monthly. Now here's the thing. You can stop early, and there are two main ways to do this. First is through what is called a premium offset. With this, you elect your dividends and interest to pay the premium for you. We're going to look at an example of that toward the end of this video. But this option allows you to have zero out of pocket, and you're using some of the earnings in the policy to cover that premium for you. The next option is referred to as a reduced paid up option. What this does is eliminate the premium altogether. So now your premium is no longer due. The drawback to this is even if I wanted to continue to pay the premium, I cannot. The advantage to this, though, is that I chop the premium off. So now all of my dividends and interest can be plowed back into my cash value, and they don't need to support a premium for me. Now, a thing we'll do quite a bit with the reduced paid up option is if someone says, I want the option to pay into this policy for a very long time, they might go with a Whole Life 100 policy. The premium's due until they're 100 years old. But if they said, well, I want to stop after 15 years, maybe they don't decide that up front, that's after the fact, what we can do is exercise that reduced paid up option, which will eliminate the premium. So now they started with the policy where they have the choice to pay into it forever, but then they elected to stop early. Does that make sense? Cool. So it's a nice option to be aware of, and you do not need to elect upfront if you're going to do that or not. It is an after the fact change. So again, the premium is set at the start of the contract. So wherever that dollar amount is set, it will not increase for the life of the policy. Now, do you have to pay it forever? No, you do not. You might decide to stop premium payments altogether, maybe after 10 years. And again, that can be done through a premium offset or through a reduced paid up option. Quick side note on the reduced paid up option, we typically cannot exercise that until after the first 7 policy years. Otherwise, we'll trigger a taxable event referred to as a modified endowment contract. Next, we have what is called our PUA rider. So this stands for Paid Up Additions Rider. I like to call this a cash dump-in, and you'll see why. So first and foremost, money that you pay toward your PUA rider is optional. Depending on the insurance company, it can even be added at leisure. Now, when you make PUA deposits to a life insurance policy, it will immediately show up in cash value, and it will receive its own dividend. It also receives the guaranteed rate. This is the key to immediately building your cash value and also accelerating the long-term growth. And what you'll also notice is that it buys you some life insurance benefit as well. So PUA payments are optional. We'll see a lot of individuals add funds through their PUA rider to their whole life insurance policy. So if I pay my premium for 10 years, I might pay the PUA rider with it. However, because it's optional, what we see happen a lot is something like this. Say someone has a premium of $10,000 per year. They pay that every year. They come into some cash and they say, I want to add more money to my policy. Perhaps in the first year, they add $50,000 to their PUA rider, which immediately shows up in cash value. Then maybe the next 3 or 4 years, they add nothing. And then down the road, year 5, they say, hey, I want to add another $100,000, which could be a lump sum deposit, or it could be spread out over the course of the policy year. Because it's optional, I can set it up where I do not get billed the same time as the base premium. Now again, this does depend on the company. Some companies will require that you pay at the same time as the base premium. If you'd like information on the PUA rider in different companies, you can check out this video here. But the key and main purpose of the paid up additions rider is to accelerate the cash value growth. Really, we're looking to put as much money as we can here. And what you'll find with most of the top companies is wherever you set your premium, say it's $1,000 per year, the top companies will usually allow you to pay up to 10x that base premium in PUAs per year. The policy needs to be set up right, but it is very, very easy to do that. Next, we've got the item everyone is most interested in. This is why people put a lot of money into this product, the cash value. So the cash value goes nowhere but up over time. A couple things on this. 1, there's no stock market risk. Your money is not invested in or tied to the stock market at all. What you'll see is a guaranteed cash value interest rate. However, most companies will have what is called a surplus at the end of each year. When I take the guaranteed rate plus the surplus rate, add them together, that gives me my total dividend interest rate. For example, if I look at all of the life insurance companies today in 2025, MassMutual has the highest dividend rate at 6.40%. If you have a product with them and your guaranteed rate, let's say, is 3%, what that means is your floor is 3%, but then a surplus was paid on top of that, which would have been 3.4%. We'll call that the surplus. When you add the two together, that gives you the total dividend interest rate. That's always good to be aware of because sometimes people think that they get the guaranteed rate plus the dividend rate that they see advertised by the company. No, the dividend rate we see advertised by the company includes that guaranteed interest rate. Now, what I always like to talk about here is the net annual return, because the dividend interest rate does not represent your net annual return. So sticking with MassMutual, if you have a 6.4% dividend interest rate, that's what would make you think naturally your money is going to grow by 6.4%. That's not the case, because the dividend rate is a gross rate applied to the policy after the life insurance expenses. The net annual return will depend on the product and how many years you have it. What we've seen with actual policies we've put in place is they're producing annual returns around 5%, somewhere closer to 5.5%. And that's for a seasoned policy that's typically at least 5 to 7 years old. And that's what we're seeing on a yearly basis. It's not the average rate of return. But it's always beneficial to look at the net annual return. If you'd like to see the average rate of return on your cash value, I would request what is called the internal rate of return. That'll give you a better depiction of that. And then lastly, with the cash value, you can access it anytime. So you can access it anytime by requesting a loan. The earliest you can take a loan from a policy right after starting it is typically 10 business days. And when I request a loan, it usually hits my bank account via direct deposit in 2 to 5 business days from the date that I requested it. That's with most companies and products. Now, why people are interested in the cash value is because it is a safe place to put money, that if I don't mess it up per the IRS rules, it also grows tax-free, and I can access it tax-free, which is very nice. So safety, liquidity, hitting on the access, and then also tax-free. How we see a lot of people use whole life insurance, I can provide 2 quick examples. One is someone who may be in a higher tax bracket. They might have money in treasury bills or a money market that perhaps is earning around 4.5%, but they have to pay taxes on the gains with those investments that they have. So after tax, they might be left over with 3.5%. So a lot of times they begin to explore whole life insurance, see that the net returns peak at 5 to 5.5%, and it's also tax-free, which means if it's 5%, it's a true 5%, and it's also very, very easy. There's no management. I see it go nowhere but up over time, and I like the growth. So a lot of times we'll see individuals use the product for that reason. And then we also see individuals use the product if they're going to access the cash value as their own line of credit or almost as their own bank. If they want to use it for their business, for real estate, a unique feature is that if I have, call it $100,000 in cash value, earning 5%, I borrow $50,000 against my policy to invest in real estate, for example, I continue to earn that 5% still in the full $100,000 because my money keeps on compounding. So a lot of times we'll see individuals use the product for those 2 reasons. There's others, but those are the 2 most popular. All right, let's talk about how to get the most cash value. And this will 100% revolve around the premium and the PUA rider. So we'll start with a classic example of what not to do, which is what happens to most people when they get whole life insurance. So what I'm about to show you is a whole life insurance product that is sold in a manner that 92% of people who own whole life insurance have it like this. A classic example of exactly what you should not do. But again, most people are sold this. So how it usually works, this is the typical approach. You meet with an agent, you get a life insurance policy. The death benefit is $1 million. The premium might be $20,000 per year. You say, I'm interested in cash value. Okay, great. When we look at the cash value, the first year is, let's look at an illustration. Here's an illustration. We put it on Excel. What is your first year cash value? You pay $20,000. It all went toward the base premium, nothing toward that PUA rider. So the annual funding is the base plus the PUA, which is all base premium in this example. And there's your first year cash value. Goose egg, 0, nothing to show for it. So if we look at the first year cash value, you are at 0. Year 10, if we look here, 162 and change. Okay, let's go back. So first year, 0, which is a $20,000 loss, by the way. And then by the 10th year, your cash value was $162,000. Now to put this into perspective, how much did you pay by the 10th year? $20,000 per year times 10 years is what? $200,000. But you have $162,000. It's a $40,000 loss. This is what people run into all the time with life insurance. And they say, why am I doing this? It stinks. And then they cash out. If we look at year 20, your cash value is 444. If we round up, it's 445. And by year 30, it's 775. 445, 775. Let's go back. See what's going on here. How long did you pay into this policy? Forever? No. So in this option, what we did is fund for 15 years. And if we pull up the full PDF illustration, you would see that the premium is still due. We exercised that premium offset, which allowed the dividends to pay the premium for us. So that's what's going on here. And the cash value continues to increase every year. So we paid a total of $300,000. And 30 years down the road, it a little bit more than doubled. It's $775. Is this an attractive policy? No. Typically, when you meet with an agent, they will always point to the long-term values, saying this should be used for retirement. The reason why is when you look at how these policies are sold and specifically what generates the compensation to insurance companies and agents, it is primarily the premium, not the paid-up additions rider. So let's take that same policy and make it a little bit better, shall we? So this still won't be good, but it will be better. So we're going to look at the exact same product with the exact same company. The death benefit is going to be lower. It's going to be closer to $500,000 actually, not $700,000. There we go. And you're going to pay the same $20,000 per year, but $7,500 will be the premium, and then that'd be $12,500 will be the PUA. Okay. So add those two together, gives you a total of $20,000. So same product, you're paying the same amount of money every year, it's just broken up differently. First year cash value, is that going to be a 0? Let's take a look. There we go. So up top, we have that it's still bad because it is. But what's your first year cash value? 11.6. How about year 10? 208, call it 209. How much did you pay in by year 10? 200. So we've got 11.6 and 209. Let's go back. If we pause right there and compare the two products side by side, which one's better here? And let's move this up a bit. When we line them up side by side, what do you notice? The second option looks way better. And again, same company, same out of pocket to you, just redirecting where the money is going. See what's going on here? Let's look at year 20 and year 30. Year 20, he's at 493, call it 494. And year 30, he's at 824. So 494 and 824. Okay. So how much more do you have in value as a result long term? A lot more. Again, same company, same product, just designed or set up differently. So this is definitely a better approach, but it's still not optimal. Now, an objection a lot of people run into with this is the MEC objection. Meaning if you asked, can I set my premium lower in order to get more cash value? You may be told, well, you can't because it will MEC. You can. What you need to do is just raise your death benefit a bit, which normally the death benefit is driven by the premium. But how we're going to do that is by adding what is called term insurance, specifically a term insurance rider, which is a cheap way. If you don't like the word cheap, think cost-effective way to raise the death benefit, which prevents a MEC or taxable event from occurring. Okay, so let's look at the good approach, which will have a term rider. We have here corporate approach, because this is what corporations do when they get policies on their executives. I know that from experience as a case designer at an executive benefit firm back in the day, which I still think about that and had a lot of fun doing so. So here's what we've got in terms of a design. Premium, $1,800. Term rider, $200. That term rider raises that death benefit where now I've got a total of $1 million. You'll see it's actually a little bit more in the example we're going to pull up. Then the rest, we're plowing into PUAs. So with this type of setup now, what's your first year cash value? Or what should it be? Let's take a look. So when we look at the good one now, your first year cash value is $17,500. Check that out. And then your year 10 cash value, about $240. Same company here. So you had $17,500 and $240. Again, we can pause here. If you just look at your values in year 1 and year 10, what do you notice here? Which one is the strongest? Let's line this up a little bit. The one to the far right. You're at 240 at the 10th year, whereas the second one you're at 209 and the first one you're at 162. Something, how designing a policy can make such a difference. Let's look at year 20 and year 30. You're going to see it is very consistent. Year 20, you're at 534. Year 30, you're at 902. 534 and 902. Okay. The guy's in the way down here. He's happy though, because he's got the most money compared to his friends. All right. So what's the difference here with these approaches? Because it's all the exact same company looking at a whole life insurance product with Guardian. The difference is that we pushed the base premium as low as the insurance company would allow. We added a term insurance rider to prevent a MEC or a taxable event from occurring. And then we plowed everything else into the PUA rider. And if we go back to the how it works section of a whole life insurance policy, are you committed to the PUA rider? No, not at all. So what's very common to see someone do in a case like this is they'll say, hey, I'll just commit to the minimum of $2,000 per year. And then depending on my cash flow, I know I can add up to another $18,000. Now I'm not on the hook for $20,000 per year, and I'm not stressed out over having to pay this big premium every year. This really helps people become more comfortable with the product. So what should I do here to make sure I get a good policy that's set up for maximum cash value? Well, there's two very, very simple things to do here. Hopefully this helps. In terms of steps, let's call it how to get the best policy. Number one, minimize the base premium as low as the insurance company will allow. So we'll have to ask the agent we're working with for this information. You can also read it in your contract, in the illustration, or you can request information about the company's paid up addition rider limits, and they should be able to provide that to you so you can see it from the company. Especially if you just hear it from one person that the limit is 3x and then someone else tells you it's 10x, it's contradictory, look for it in writing. Next, major mutual company, which these companies are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. We'll always recommend these companies. The simple reason why is because we've seen consistent proof of performance, meaning not games where they overpromise and underdeliver. We track the performance. We've seen those companies deliver. That's why I always like to recommend them, because there's proof there. And people are often hurt when it comes to whole life insurance because they get it. They look at the illustration, numbers look fantastic, but then it underdelivers. It's like, oh, come on, man, I thought I was gonna have more money. So how do we prevent that as much as possible? Design a policy with a minimum premium and go with one of the major mutual companies. Ton of information. I hope this helps. If you have any questions or would like to check out more information, we've got a video here that provides more information on whole life insurance, or you can check out our website where we've got several case studies that go through real application of how people have used their policies. Thanks so much for watching, and as always, I hope this helps.